Today, the US Q2 GDP exceeded expectations, and the market reacted first with hesitation and then with gains. What kind of contradictory psychology does this reflect for investors? Will AI take away our jobs? A recent Goldman Sachs research report may provide some guidance. US GDP data has officially been recorded on the blockchain. Does this signal another spring for cryptocurrencies, or is it just a crypto show? Fed Governor Lisa Cook has officially filed a lawsuit. A single clerical error may end up redefining the Federal Reserve Act. Tonight, we will break down all four of these events. Make sure to like the video before watching. Let's get started. Today, the three major U.S. indices opened lower but closed higher. The S&P 500 hit a historic high, successfully breaking through 6,500 and ending at 6,501.86, up 0.32%. The Nasdaq rose 0.53, and the Dow increased 0.16%. By sectors, communication services led the market, rising nearly 1%, while energy and technology gained more than 0.6%. Utilities led the losers, dropping 0.87, while consumer staples and healthcare fell over 0.4. Other sectors fluctuated narrowly, with swings under 0.3%. This morning, the U.S. released a series of heavy-hitting economic data, painting the economy as unusually strong. However, the impressive numbers did not immediately excite the market. In fact, the market dipped slightly after the open. It was not until midday that sentiment turned positive, with the S&P surpassing 6,500 to reach a historic high. Why did the market first weaken and then rally? What contradictory mindset is being reflected here? Let's look at the key data. US Q2 real GDP, annualized and seasonally adjusted, grew 3.3%, revised up from the initial 3.0%. This revision was mainly due to strong corporate investment, which jumped from an initial 1.9% to 5.7%. Exports and imports also contributed roughly 5% to GDP, a historic proportion. However, consumer spending, the main engine of the economy, grew only 1.6%. Gross domestic income GDI surged 4.8% in Q2, far higher than Q1's 0.2%. This suggests that the real strength of the U.S. economy may be even greater than GDP alone indicates. And it indirectly shows that U.S. companies can still pass costs to consumers, implying potential inflationary pressures. Regarding the PCE, core PCE excluding food and energy grew 2.5% in Q2, in line with expectations. The number is not low, but it does not show any unexpected upward trends. In the labor market, initial jobless claims came in at 229,000, below the previous 234,000 and the expected 231,000. Continuing claims were 1.954 million, lower than the prior 1.961 million and below the forecast of 1.97 million. Initial claims fell slightly, while continuing claims remain high but are showing signs of decline, suggesting the labor market remains relatively healthy and stable for now. Overall, this data indicates that the fundamentals of the U.S. economy are very solid. Whether looking at the breadth of growth, labor market resilience, or inflation stability. However, perhaps it is precisely this strong report card that makes the market feel conflicted. Stephen Stanley, chief U.S. economist at Santander U.S. Capital Markets, commented that he suspects today's data could alter the Fed's thinking, creating resistance to future rate cuts. Kevin Georges, a fund manager at Ecofay, warned that markets may be too confident about pricing in rate cuts. If the labor market proves more resilient than expected, investors may have to adjust their expectations downward. Thus, the market's contradiction is that strong economic data is inherently good news, but because it looks too good, it weakens the rationale for Fed rate cuts. Directly conflicting with Wall Street's current expectations, the market's muted opening reflects this logic, as do short-term spikes in the dollar index and treasury yields, indicating investors' contradictory psychology and the bond market's downward adjustment of rate cut expectations. However, after midday, the market suddenly improved, with the S&P rising from a low of 6,466.96 to break the all-time high of 6,500. What does this reversal say about market sentiment? Chris Tallarini from Northland SM Management commented that we may have been overly anxious about tariffs. The economy now seems to be firing on all cylinders, which should boost confidence. The September rate cut had already been priced in, so the key factor now is inflation. As long as inflation does not spike unexpectedly, the market should continue to rise. Zachary echoed this logic. The market can rally without relying on rate cuts, simply because the economy is strong. No hot inflation, no recession, markets should not fall. Historically, bad news was good news. Weak economic data increased the likelihood of rate cuts and economic stimulus. Now we may be returning to a more straightforward logic. A strong economy, strong companies, strong fundamentals are the main drivers of stock market gains. I personally agree fundamentals remain the most important logic for stock growth, focusing too much on the surface level positives or negatives of rate cuts can make investors lose focus and potentially incur unnecessary losses. The key in the macro market remains the balance between inflation and employment. As Powell said, if employment weakens, the Fed may cut rates, which is not necessarily good for the stock market. If inflation rises, the Fed will hike rates, which is even more damaging. Any disruption to this delicate balance can shock the market in either direction. Discussions about whether AI will take away our jobs are becoming more intense. On one side, tech companies continuously release more powerful AI models. On the other, there are news reports of layoffs. Will AI lead to widespread unemployment? Goldman Sachs recently released a 1000-word report analyzing this issue using data. The team analyzed over 800 occupations and concluded that if AI is widely adopted, approximately 6-7 of the U.S. workforce could be replaced. During the current AI transition, the U.S. unemployment rate may temporarily rise by 0.5%. Why is this effect temporary? The report cites historical patterns. Every major technological shift historically created far more jobs than it destroyed. For example, 60% of American workers today are in jobs that did not exist in 1940. Over the past 80 years, over 85% of employment growth came from technology-driven new jobs. Goldman Sachs concludes that AI will indeed replace some jobs, but the effect is largely temporary. The AI transition is more like a period of job displacement rather than permanent job loss. Some sectors have already seen this impact, including marketing, consulting, graphic design, office administration, and call centers. Tech roles, such as computer systems design and software publishing, are also slowing sharply, affecting younger workers more significantly. The highest risk occupations involve repetitive tasks, such as programmers, accountants, and auditors, legal and administrative assistants, customer service representatives, and telemarketers. The lowest risk occupations require complex decision-making, high interpersonal interaction, or fine physical tasks, such as air traffic controllers, corporate executives, radiologists, pharmacists, real estate agents, photographers, and clergy. Researchers also note that AI's impact on employment is still in its early stages and will largely depend on how employers use the technology. Until the AI cycle is complete, its disruption of the labor market remains an open question. Finance Dean Smith believes AI's threat to jobs is temporary. AI may replace some demand, but new, unforeseen demand will inevitably emerge, driven by human needs. This report reassures that AI's current impact on employment is not catastrophic and provides a useful guide for career planning. Today, the U.S. Department of Commerce announced a pilot program to publish core data, such as GDP, on a public blockchain. This data is significant enough to influence global markets. The department's aim is to create a new verifiable distribution channel, not to replace existing methods. The plan involves uploading official GDP hash values to public blockchains like Bitcoin or Ethereum. This hash acts like a unique digital fingerprint, giving the data an identity in the blockchain's digital world. The official explanation emphasizes verification. Websites can be hacked, press releases can contain errors, but the blockchain fingerprint is permanent and immutable. However, the deeper motivation may be political. Reports indicate that Secretary of Commerce Lutnick briefed former President Trump in advance, saying, "We are doing this because you are the crypto president." This aligns with the Trump administration's pro-crypto stance, including government cryptocurrency reserves, stablecoin regulation, and commercial investments by the Trump family in mining, media platforms, and prediction markets. Today, a Bitcoin mining company co-founded by Eric and Donald Trump Jr. merged with publicly listed Griffin Digital Mining, planning an Nasdaq listing. After the merger, the Trump family and partners will own 98% of the company. Their goal is to become the world's largest and most efficient Bitcoin miner. Finance Dean Smith believes the Commerce Department's blockchain initiative is a positive experiment that could guide other data to be recorded on-chain. Yet the political dimension of cryptocurrency in the US is increasingly apparent. Investors should follow the trend and understand this market early. Trump's attempt to fire Fed Governor Lisa Cook escalated today. Cook has filed a lawsuit to block the illegal dismissal and bring the dispute into the legal system. According to the court filings, Cook argues that Trump tried to remove her using a false pretext, which legally does not justify firing a Fed governor. The filings also indicate that prior mortgage application errors, unrelated to any personal gain, were cited as grounds for dismissal. Cook's lawyers argue that the president did not provide any explanation before attempting to remove her, violating her constitutional due process rights. Cook is seeking a temporary injunction to block the dismissal. Finance Dean Smith notes that the focus is no longer the clerical error but the legal interpretation of just cause under the Federal Reserve Act. If Cook wins, it limits presidential power and safeguards Fed independence. If she loses, it could set a precedent allowing trivial errors to justify firing Fed governors, which could damage both Fed independence and democratic institutions. The case is still in the early stages and will take time to resolve. Finally, if you find Finance Dean Smith's videos helpful, please support by clicking the Interactive Brokers IB link in the pinned comment. IB offers high, risk-free interest on uninvested cash up to 4.33 with zero commission per share, low-cost options trading, and economical currency conversion. IB's platform is robust, especially for options trading, with free research, tools, and timely news. It's affordable and user-friendly, akin to the Costco of brokerages. That's all for today. If you enjoyed the video, please hit like. Producing content consistently is not easy, and your support matters. Thank you.